Why would a central bank raise interest rates while its own factories are turning off the lights? That is exactly what happened in Jakarta this year. Behind the official statements sits a deeper question about who actually sets the price of Indonesian money. Act 1. The emergency meeting in Jakarta. On a humid Tuesday afternoon in late June 2026, high above the traffic of central Jakarta, Governor Perry Warjiyo called an unscheduled emergency meeting. Outside, delivery drivers were already feeling the daily squeeze of fuel and food prices. Inside, the central bank was fighting a far more immediate fire. The rupiah had just touched a record low of 18,200 to the US dollar. A drop like that threatens to spark an imported inflation shock across the whole archipelago. Warjiyo called his team in to halt the slide before it hit household prices. Bank Indonesia forced through 3 separate rate hikes over May and June, adding 100 basis points to push its benchmark rate to 5.75%. By the 22nd of July, the tightening paused. The rupiah pulled back toward 18,000. Inflation stayed within target and officials declared victory. There was no celebration in industrial hubs like Cikarang. These hikes were not a response to an overheating economy. Bank Indonesia raised rates defensively to stop foreign capital fleeing to higher yields in North America. To protect the currency on trading desks, it squeezed domestic borrowers instead. Indonesia holds full legal sovereignty to set its own interest rates, but in practice, its real borrowing costs are dictated by the foreign investors who hold its debt. When global sentiment shifts, domestic rates move to satisfy international capital. Whatever is happening on the ground at home, that is what the official numbers say. The bond market tells a different story. Act 2. The short-term capital trap. To understand how a sovereign nation loses control of its own borrowing costs, follow the trail of government debt. The way a country structures that debt decides whether it keeps genuine policy independence or stays exposed to every shift in the global mood. Back in 2007, foreign investors owned close to 40% of Indonesia's local currency government bonds. Over the following 2 decades, Jakarta deliberately worked to close that vulnerability, driving foreign ownership down to a record low of 12.6% by May this year, as domestic banks and insurers absorbed the difference. On paper, it worked. Except the exposure did not disappear, it moved. To attract foreign capital without lifting long-term borrowing costs, Bank Indonesia turned to short-term paper known as SRBIs, short-term rupiah securities issued by the central bank. By June, 1-year SRBIs were yielding 7.25%, more than the 10-year government bond at 6.9%. By mid-June, non-resident investors held 238.1 trillion rupiah in SRBIs, close to a quarter of the 1,021.1 trillion rupiah outstanding. Foreign capital was no longer watching from the sidelines. It had become the largest single hand on the instrument the central bank relied on most. Indonesia had swapped one vulnerability for another, long-term bond risk for short-term money that can leave overnight. Meanwhile, domestic banks parked their own cash in 7% central bank paper instead of lending to local businesses. The rupiah held, domestic credit stalled. Act 3. The toll on the factory floor. When a central bank uses interest rates as a shield, someone in the real economy catches the falling sword. The decisions made in that Jakarta boardroom land directly on business survival and jobs on the ground. Bank Indonesia's own business survey showed hiring momentum slow sharply in the second quarter and manufacturing employment contract for a 5th straight month. Behind that number sit real factory floors going quiet. A mid-sized manufacturer now faces rising electricity costs, imported raw materials priced in an expensive dollar, and commercial loans above 10% interest. To survive, owners halt hiring and cut shifts. The Ministry of Manpower recorded 43,000 formal layoffs through June, with unions warning 50,000 more jobs are at risk. Economist Jahan Reski of the University of Indonesia put it plainly. Raising interest rates does nothing to fix price pressure coming from global energy shocks and supply chain disruption. Hiking rates to protect the exchange rate tried to fix an external shock by suffocating domestic business. The defense held the rupiah steady on trading screens in Singapore and London. On the ground in West Java, it meant smaller paychecks for factory workers buying cooking gas and rice. Act 4. The divergent path across the causeway. The clearest proof that Indonesia's dilemma is a choice, not fate, sits just across the Malacca Strait. Indonesia and Malaysia faced identical pressure in 2026. Elevated US interest rates, volatile energy prices. Bank Indonesia pushed through 100 basis points of emergency hikes. Bank Negara Malaysia held its policy rate steady at 2.75%. Indonesia leaned on high-yield short-term paper to keep foreign capital in the door. Malaysia leaned on a deep long-term bond market, one that let its central bank keep rates low without triggering capital flight. Institutions like the Employees Provident Fund and major domestic insurers act as permanent buyers of government debt. When global investors pull back, these funds absorb the bonds instead. In June, Malaysia attracted 4.9 billion ringgit in net foreign bond inflows, capital arriving by choice, not by force. Act 5. Two futures for Indonesia. If global rates stay elevated, Indonesia faces two very different paths ahead. In the adverse version, high borrowing costs keep squeezing businesses, industrial layoffs deepen, and state finances drain under rising debt service. If political pressure forces rate cuts too soon, capital flees, the currency drops, and the central bank is forced into another round of even harsher hikes. In the constructive version, Jakarta uses this calmer window to expand retail bond sales, widen the mandate of state pension funds like BPJS, Indonesia's Social Security Agency, and pair that with tools that push commercial banks back into lending. Stable domestic funding starts replacing volatile foreign capital. Act 5. The real meaning of sovereignty. Bank Indonesia's July pause carries a quiet lesson that reaches far beyond the currency desks of Jakarta. It says something about what economic sovereignty actually means for fast-growing economies across the region. Indonesia has clean elections, an independent central bank, and healthy foreign reserves. Governor Warjiyo's team operated with real skill, keeping inflation anchored and pulling the currency back from a dangerous slide. But formal institutional independence alone does not protect an economy from external pressure. True monetary sovereignty needs deep pension funds, local insurance pools, and liquid domestic capital markets. Without them, when global conditions turn, a central bank is left choosing between sacrificing the currency or sacrificing growth. While central bank auctions in Jakarta offer 7% yields to overseas portfolio managers, factory workers in West Java adjust to shorter weeks and smaller paychecks. That is where the cost of relying on foreign capital ultimately lands. How many emerging nations in this region can genuinely afford to set interest rates for their own people? And how many are simply paying rent on capital borrowed from someone else? I am Hero the Hornbill, and this is the ASEAN Angle. If this episode gave you a new way of seeing the region, subscribe so you do not miss the next one. New episodes weekly, link in the description.